What's up, everybody? It's Alex from the Stock Operator channel. The account's sitting right around 124,317, basically flat from my last video, and up about $2,400 from last month. But what's fascinating isn't the number, it's why. We made a ton of new moves under the surface as we were on our vacation, and even as the S&P 500 and Nasdaq are hitting new highs, the portfolio is not keeping up. That's because this portfolio is diversified with US small caps, international equities, bonds, and fixed income. Now, so when a portfolio like this is divergence from the S&P 500, that's not random, that's rotation, and we got to listen to it. So in today's video, I'll walk you through what's shifting, what it means for the next leg of the market, and how I'm positioning myself going forward. If that's what you're into, stick around. So what you guys are looking at here is the equity curve for the account. I like to keep track of this. And also what I put on here is a 16 period moving average of the equity curve. And as you can see here, when the equity curve is above the 16 period moving average, all is good. And when it dips below the 16 period moving average, we got to be a little bit cautious because that's when things can get dangerous and fall apart. So, right now we are dipping below that 16 period moving average. So we're going to get on the defense, okay, because we want to get our equity curve back above that 16 period moving average and moving into new high ground. So this is my drawdown of the account as well. And as you can see here, typically the average drawdown is about 0.6-ish%. And every time it gets, a little bit extended, right now we're in about a 2.6% drawdown. We want to get cautious and we want to get defensive. So that we can, we don't want the account to totally fall apart. So whenever the drawdown is exceeding our average drawdown, we like to watch out for that. So here's the rate of return for the account. We're up about 25% on the year. We're outperforming the indexes, but recently we've been losing ground to the QQQ and the S&P 500. That's because we are hedging the account with the QQQ, and actually the QQQ made a big move to the upside, whereas a lot of the small caps that we are in made moves to the downside. So our hedge actually hurt us and we were going down. So we got smacked two ways. And that's the unfortunate thing about hedging. If you end up having a move like this, you get a double whammy of hurt. And so we're watching that really closely. And this right here, this is the drawdown for the IWV index. It's a little bit delayed. It's not accounting for today's up move, but it's also in a pretty decent drawdown, about 1%. But we're outperforming that drawdown because we're down about 2.6%. So we want to get that back above, and we want to be outperforming that index. So for those of you who are new to the channel, the allocation of this account, as I said at the very onset, is about 33% US small caps, 25% international. We have 21% in fixed income, and then we have some options positions, and then we have some large cap positions. Generally, in Tesla is our large cap exposure. But what's really interesting about what's going on right now, if you've seen any of my other videos, is the breadth is just really, really bad. It's akin to 2000 when there's a lot of spend on fiber and the internet rollout, and the economy wasn't doing so well. And that's very similar to what's happening right now. And because we're diversified, we're getting hit because we're not all in on AI. From the surface level, you'd think that the broad indexes are broad, but they're really not broad at all. They're very highly focused towards AI and the mega cap stocks, which are basically taking all the growth. So that's something to keep in mind. We can still outperform the index, but we want to watch that closely. So this is a tweet I wanted to show you guys. This is something that just flashed, yesterday and the day before, and I'm seeing it in my account too. Whereas there's something called the Hindenburg Omen is triggering. So this is basically just a breadth indicator when there's a lot of stocks making new lows. There's a lot of bad breadth in the market, and the market's making new highs. But then there's also a lot of stocks going up a lot. That's when this thing triggers. And typically, it's done a really good job of timing tops. It's also done a good job of timing explosions where the market can keep going up really high. But I thought this was an interesting tweet from this bar chart guys, and they kind of explained, the moves, 1 month, 2 months, 1 week, 2 week later, the move that can happen once this thing triggers. And then there's another guy. This is Tom McClellan. He's another TA guy, and he got also grabbed some data for when this thing triggered. And as you can see in the onset of the bull market, it triggered, but it kept going up higher, right? Triggered, kept going up higher. But then, it does a pretty good job sometimes when it catches these downturns. Um, so it's just something to note. It did a really, really good job the last few times. In COVID, it timed that. In 2022, it timed that. Before the April decline, even though that was self-inflicted by Trump, it timed that, and now it's triggering right now. So that's just something interesting to keep in mind, that there's something going on under the surface. My account is showing it, because we're kind of diversified into small caps and other things, and that's why we're not performing as much as the index. All right, so what I want to go over in the rest of the video is just kind of show you guys the big moves in the account. So what you're looking at here is the holding performance from when I went on vacation. And as you can see, there's a lot of red. A lot of things didn't really do so well in October. I mean, from everything from tech, from some of the AI names, to silver, gold. A lot of the debt instruments didn't do so well, and the Chinese stuff didn't do well, and Bitcoin didn't do so well. So there's a lot of things that didn't do well, and the things that did do well were like oil stocks did really well. Some special situation stocks like the Zim did really well, and then some chemical stocks did pretty good. And then BitDeer, which is a data center play, which is the AI stuff, which is actually exploding at the moment. So we're going to go over some of the charts for the rest of the video. I don't want to make this one too long because I'm just getting back into the swing of making these videos, and just show you guys what's going on TA wise. So one thing I wanted to highlight today is just some of these retail names that are just getting hammered. So you can see here, this is Chipotle Mexican Grill. This thing has been in a big downtrend. Restaurants have not done well at all. They're saying that the consumer is really struggling, and it's basically, just showing us that if you're not really wealthy and doing, the AI build out, your chart looks like this. Pretty nasty move here. Another stock is this FMC. This one is a agricultural inputs kind of stock here. Just getting hammered. Another one, which is FI. These guys have this Clover instrument. When you go to buy something at a store, they have the kiosk that takes your credit card, and that's not doing so well. What else? Toast. This is another retail stock that's not doing so well. But then you have stuff like Credo, which is a AI play that's just going bananas. You have a stock like EOES. This is a speculative battery play that's going bananas. You have a QS, which is another speculative battery play that's going bananas. And then, of course, you got NVIDIA with the nice big breakout here. Did really well. Apple, it had a nice big breakout. It looks like it failed today. Google had a nice breakout here. But then we're seeing Meta, it's starting to go down. And this actually looks like it's going to start another downtrend. It looks like the market's going to not like them for spending so much money on AI. And then something that's really interesting, that I wanted to show you guys is Oracle. There's a tweet that got put out that the credit default swaps for Oracle are actually, spiking here, because these guys are taking on a lot of debt to build out these data centers. So it's just an interesting thing to note. I also wanted to show you guys Bitcoin. It's up today. It keeps bouncing off this area, but it's just really choppy in here. And it's a neutral-ish sort of thing, because it's still above this level right here, which is kind of the key level that it needs to kind of stay in. But just stocks like this are not doing well. Palantir keeps making new highs. That's another AI play. If you're in the AI, you're in the mega cap AI, you're doing really well. But now that gold has topped, there's a lot of things that are awry. underneath the surface. The KKRs are not doing well, the private equity stuff. Now, that's kind of the big picture of what's going on in the market. AI, big cap is doing really well. Retail, consumer spending, that sort of thing is not doing so well. Private credit is not. We're seeing some blowups in private credit. But what I wanted to show you guys is some oil stocks, and that's what we're kind of into, because we have a kind of a thesis that potentially with all this AI build out, eventually it's going to get to energy. So we're seeing like stocks like Rig. This is a offshore driller, start to pick up steam here and do really well. And it's not extended like some of these other stocks. So it has a lot of room to run, I think. And this one has actually been performing well for us over the month. This is Zim. This is a shipping company. Now, I mean, these guys have like $24 per share of cash. And they say that the total value of the business is like $50 per share, but the insiders want to keep it down because they want to take this thing private. So that's another special situation. We kind of added to it down here. Just certain special situations are doing okay. But the last thing I wanted to show you guys today is the chemical stocks. We're starting to add into the chemical stocks because I think it could be a nice opportunity, because these things have been in a nice big downtrend for a long time, and their Dow came out and said that they're going to start doing much better. So Dow Chemical, one stock that we actually entered today was this CE. It's got earnings coming up here, and the numbers are really bad. They say and they said they're going to cut costs, and things are looking pretty horrible for this. But we like this position. We like the risk reward here. We like that Dow came out with good earnings, and then also another stock, MEOH, is another chemical company, came out with earnings, and they're actually expanding, and they're gonna growth is coming back to this mix. I'm not sure if it's going to actually affect CE. I just like the position of it, and I like that it's got earnings. And most of the stocks in the chemical sector have been doing really well. So with that, I don't want to make this video too long. That's basically what's going on this week. Account is basically flat in October. We're in a drawdown. We're getting defensive. We're going to trim some stuff, and we have trimmed, but we might trim a little bit more. The hedges are clearly not working. We need to change to a different hedge, not instead of the QQQ, or maybe we keep the QQQ. We're still figuring that out. But hey guys, if you like the content, feel free to hit that like button and subscribe, and I'll see you guys on the next video. Cheers.